Hi, welcome to the Elevate Market Chat. In this episode, Shane and I check in with the latest rate cut expectations and share some thoughts on the Goldilocks economy. We then review Tobin's Q and Shane's recent comments and what it says about the market valuation. We then check in with Tesla earnings and the state of the American consumer. Thanks for tuning in. Shane, how's it going?
Hey man, it's going. Things are good, busy. Looking forward to a quick chat on the markets with you here today, man.
As am I. And it's funny. So today's July 25th, the time of recording. And I think the last time we met, we're at the same place if you're looking at the S&P 500. So we went a little higher for a minute, and now we're just kind of back where we were at that call.
Wow, I didn't realize it was flat over the course of the past 30 days, but that doesn't surprise me.
Yeah. So, and one thing that hasn't changed is this term that keeps coming up, and I just thought maybe we would start there, but the Goldilocks economy. Yeah, I looked this up, and it's interesting. What that is really just everything's just right. But I think what is concerning is it's coming from a place of justifying what's taking place, because it's kind of that story of this time is different. You probably have some general thoughts on that, but are you getting a little annoyed with this term at this point? And what are you thinking?
I actually haven't seen too many people calling it Goldilocks. At least not recently. Maybe a couple of months ago. So I guess I'm not totally familiar with what part of it is Goldilocks. I mean, to me, inflation is still higher than they would want it to be, and unemployment is ticking higher. The amount of debt that we have is unsustainable and rising. The amount of interest that we're paying on our debt is unsustainable and rising. Foreign governments are less and less willing to buy our debt, which means interest rates will probably stay a lot higher for longer, even if the Fed tries to cut rates at the short end of the curve. The yield curve seems to be steepening again, and maybe the tens minus twos will actually go positive today for the first time in over 2 years, which is generally a signal of impending recession. So I don't know. I guess maybe you're reading different stuff than me, but I haven't seen too many people calling this economy Goldilocks. It doesn't mean it's not happening. It just means I don't know. I can't pay attention to everything, so haven't really seen much of that myself. And I see a lot of reasons to be really cautious, to be honest. And of course, I also see, the market just kind of, other than the past week, relentlessly climbing. And as I wrote about in my commentary, my most recent commentary, the month of June saw the S&P 500 rise, but the Russell 2000 was down and the S&P 500 equal weight was down. That's sort of reversed so far in July. But yeah, I don't know. I'm not sure if I would refer to it as Goldilocks. So I don't know. What do you think?
I don't believe it. Where I've seen it is, Bloomberg's news. I have that playing in the background during the workday. So I'll hear it on there, people talking about it. But, the big one has always been this, well, the rate cuts are going to come perfectly in line with expectations because inflation has been brought back to a range where it should be. But here we are, it's towards the end of July, and Shane, I think you shared it with me what the odds were of a rate cut in September, which the next meeting is September, and then they will announce on the 18th. But have you checked in on that statistic as of late?
I do have it pulled up, but just quickly, there is a meeting on July 31st, by the way. So they do meet once before September. The meeting will end on July 31st, which is next week, which is why you don't hear much from the Feds this week. They're in their blackout quiet period. So they will meet Tuesday and Wednesday next week, and they will probably not cut rates next week. The odds of a cut next week are 6%. The odds of a cut, a quarter point cut on September 18th is 105%. So market's pretty sure they're going to cut rates in September. We'll see how that evolves between now and September. We got GDP number today, which was higher than expected, which is not going to make them more likely to cut rates. If anything, it's the higher GDP number puts them in a better position to kind of sit tight and not do anything, not hike, not raise, just kind of keep it even. But the market, tends to force the Fed's hand. So the Fed doesn't like to surprise the market. If we head into the September meeting with 100% odds of a rate cut, the Fed will probably cut rates because they don't like to surprise the market. Usually leads to some fireworks in stocks and bond prices for that matter. But last time we saw, I mean, I think it was at the beginning of this year, right? 3 months, 3 months later. So at the beginning of this year, the market was pricing in 100% chance that the Fed would cut rates in the March meeting, and that there would be 6 rate cuts in 2024. So far, there have been 0 rate cuts in 2024, and by the time we got to that March meeting, the odds of a cut in March were 0. So just because the market is currently pricing in 105% chance of a rate cut in September does not mean that there will be one. Those odds can evolve between now and then as we get new economic data as far as inflation and unemployment numbers primarily. We'll see what happens. I'm kind of 50-50. Maybe they cut, maybe they don't. Whether I think they should or not is kind of not the relevant point. My job is to react to what they will do, not what they should do.
Mm-hmm.
So we'll see. My opinion is that they should not cut rates, but they don't call and ask me for my opinion actually. So
Yeah, and I know your opinion, going into the year was, I think you had 0 rate cuts for the year. Is that correct?
I said 0.
Yeah.
And only the only way I saw them cutting rates is if we were in a recession with very quickly rising unemployment rates. That was the only way I saw a cut happening. And we are seeing the unemployment rate tick higher, and sort of surprisingly so. There's something called the SAHM rule, SAHM rule. And if you're not unfamiliar with that, you can type it into the old Google machine or maybe ask ChatGPT to tell you what it is if you're into that AI thing. Perplexity AI, by the way, has been pretty helpful. I have to admit, it's pretty cool. But anyway, if you're unfamiliar with the SAHM rule, you can check that out. It is flawless at predicting recessions, and it is about to trigger because the unemployment rate has ticked high enough that we're kind of right on the doorstep of the SAHM rule triggering, which would mean that a recession is actually already underway. So I'm not sure if that will trigger, but it's very close to triggering. And if it does, it will signal that we are probably already in a recession, and that indicator has never been wrong before. So
Interesting.
it could always be a first time, right? I'm not saying that because it's never been wrong doesn't mean it never will be wrong, but for now, it's got a flawless record.
Yeah. And what's been interesting is, so you had your opinion on rate cuts. The general market had this expectation of more rate cuts. And the stock market has kind of behaved independently of those expectations. And then in your last commentary, you were talking about a measure that I thought was pretty interesting, and that's Tobin's Q. And I think the understanding there is really just, well, how are we priced relative to what the underlying value of a stock should be? Does it seem like we're stretched? Are we under? Can you tell us about that a little more?
I'm a pretty big investment finance economics geek, but I don't really know a whole lot more about Tobin's Q than what I wrote about Tobin's Q. Actually, I didn't write it. I kind of copied and pasted another analyst that I have a lot of respect for that was talking about the Tobin's Q. So, I don't know exactly, how to calculate it on my own. I know what it is and what it means and all that type of thing. But, the big takeaway is that, well, first I want to back up. The stock market hasn't really acted independently, but the top 10 stocks have. So 10 stocks have done very well, and the other 490 stocks in the S&P 500 have actually gone down on average this year. So, I think the bigger factor is that the market is a very bad measuring stick of a diversified portfolio. But at any rate, the Tobin's Q for the stock market, looking back through history, is at a relative all-time high. And so the other times that it has been at levels like this, where I think in the 1960s and the late 1990s, or maybe right in 2000, um, and they got very low at the bottom of bear markets, right at the end of bear markets. So the levels that we're seeing in the Tobin's Q ratio um, right now is just saying, it's time to be cautious, and that buying stocks today, particularly a lot of these technology stocks and AI stocks and cloud computing stocks and that type of thing, your returns from here are likely to be poor. You know, doesn't mean you're going to lose a whole bunch of money, but if you look even at Microsoft from like the year 2000, I think it took Microsoft like 13 years or something to get back to its dot-com bubble high, right? So stock bubbles, they they're bubbles because they keep inflating and people keep buying these stocks. And so, if you want to buy these stocks, more power to you. I think you could do that as a momentum trade. But you got to know when you're going to get out, because if this is the top of a bubble, or if this is even in the top, say 20% of a bubble, like let's say you could go up and make 20% from here before the bubble finally peaks and before it explodes. Well, I mean, 20% is great, over the next, say, 3 or 6 months. So might as well go try and make that money if you're into momentum strategies, but just know when you're going to get out, because when it comes down, it's going to come down a lot more than 20%, right?
Hmm.
And it could last for years. So you might not want to be holding the bag for the next 13 years in even a great company like Microsoft. Um, if it's going to take 13 years to get back to its high, from this bubble peak. And make no mistake, we're definitely in bubble valuations if history is any guide, just by looking at, say, this Tobin's Q ratio. And there's plenty of other ratios that you could look at that say the same thing.
Yeah.
So I think we're probably in the later stages of this bubble in everything, and returns from here are likely to be poor.
Yeah. And I think a couple interesting things that are worth, hitting on is one, in your description you just gave, you said likely. And that's what's so important is everyone can come out, try to be an economist, but when it comes to managing money successfully in the market, it's always understanding the likelihood. It's not a given.
Yeah.
So right now we're stretched to the upside, and Tobin's Q, that's great. So it's measuring essentially market cap relative to what replacing that company would cost. But another one that for me is a little simpler is just like Bollinger Bands. Just
Yeah.
I want to know like what's the average that a stock trades at. And if it's towards the outer bands, that means it's at like a 1%, chance that it's going to stay out there. And
Hmm.
right now you just have a market that's pressed against that if you're looking at the S&P 500 on the upside. So it's just overstretched. So the likely outcome just doesn't look great 10 years down the road, but we could certainly see a 20% run like you're saying in the interim. So if you form that plan now of how to respond to that, you can be very successful. So maybe that's trimming some on those rallies, but definitely you don't want to come in and say, I'm just going to buy it and hold it for 10 years right now. Hey, if you've got 30 years, great. But it's just a challenging market to feel optimistic.
Yeah, no, yeah, you're good point on the likelihood thing. I mean, just because the likelihood of poor returns from here for the next 10 years is high, right? Doesn't mean that's absolutely the way it's going to pan out. Maybe I'm totally wrong, and maybe history is a really poor guide to what's going to happen next. I mean, just like, the Fed, um, like I said earlier, right? It could be, but or the SOM rule is what I was talking about actually. But just because it has a perfect record of predicting recessions doesn't mean it will have a perfect record of predicting recessions for the rest of my life, right? That may change, and so maybe this bubble will inflate way 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 more than all the other bubbles ever did, and now is a great time to buy. That's always possible. I think
Yeah.
it's unlikely, but it's certainly possible.
Yeah. So then if we kind of change that picture now to just what does the market look like overall? So the S&P right now, and this is as of yesterday's close, was up 13.8% year to date, and the equal weight was up 5.8. And what that's kind of telling you is to your point earlier, you can have a stock with a high market cap, so that's worth a lot, like Nvidia that has really pushed the S&P higher, and you can have all the other names just kind of flatlining or maybe even going down. And then the NASDAQ's up 15.5%. Uh, After yesterday's sell-off could be down. I think the big thing right now is we did see a good sell-off as of late, but now we're kind of sitting around, support area. So that's just looking purely at price action. Unfortunately, we have the call today. I kind of wish maybe it was next week just to see the outcome because we're sitting right on support in terms of what I look at. What are you seeing in terms of what you're looking at, whether it be sector specific or just kind of looking at the market or how you measure where we are relative to support and resistance?
Yeah, I mean, I look at the on the intermediate term. I've been watching the 50-day moving average. This morning, the S&P 500 dropped below the 50-day moving average for the first time in quite a long time. I had to actually restart my computer before we started this chat, so I'm actually trying to pull my trading software back up. I don't have it open right now. But as of when we jumped on this call, we were slightly back above the 50-day moving average. However, um, leaving the 50-day moving average aside, we're definitely trading below the trend that I think started. Man, I don't have it in front of me. Give me just 1 second.
Yeah, not a problem. And while you're pulling that up, so when I'm looking at just the S&P 500, we're up about 1% today, but it's bouncing right off of what I watch for short-term support, which is usually 20-day moving average. So it's right in that spot where after a day like yesterday, it bounces expected. So I'm not going to take away too much from that. But
Oh
if we
yeah.
move another, 1 or 2% lower from here, I think that's when the tides start to shift a little more.
Yeah, no, definitely due for a bounce today, especially with the GDP coming in better than expected. I mean, there was some data this morning that I think the market was looking for any reason to bounce. The market was down. Let's see, I finally got my trading software open, but at the lows this morning, S&P 500 was down 5% from its recent high. That was on July 16th. And the trend I was talking about goes all the way back to October 27th of last year. If you draw an upward sloping trend line on the S&P 500 index, not the SPY or whatever, just the actual index price, um, we broke below that for the first time since October 27th. And I think yesterday was the first day that the market dropped more than 2% all year. Um, so yeah, what was it? We were down yesterday. We were down. Uh, Bummer, it's not going to tell me. Um, but a little bit over 2%. I think 2.25% yesterday. So that was the first 2% drop all year. Usually those kinds of drops come in waves, right? It's usually not just one of them, and then everything's okay. Usually you'll see a few of them kind of all tightened up together within a few week range. So it wouldn't surprise me to see markets trend lower from here and have us dip back below that 50-day moving average. I mean, for now, the 50-day moving average is still rising. The 200-day moving average is still rising, and we're way above the 200-day moving average. I mean, as of right now, the market would have to drop another 9% to get back to the 200-day moving average. That's right around 5,000. Today, the market's trading at 5,475 as we're talking. So I think there's a lot more downside there. And, a 9% pullback from here would mean we were down, say, 15% from highs and we get back to the 200-day moving average. To be totally honest, like if I were bullish, I would look at that as a really healthy development for a good long bull market, right? I mean, you see these kind of pullbacks back to the mean, right? Reversion to the mean, and then they continue their trend, that march higher. So for me, if I was a bull, which I'm not, we're actively long, right? So I can be both bearish and long stocks at the same time. That make no sense. Um, but if I were bullish, what I would expect to see is some 10 to 15% pullbacks within a longer cycle bull market, and I think that would be healthy. That gives the bull market more fuel, basically, to keep rising, right? Because it gives more people an opportunity to buy in and gets that excitement generated again. And so these kinds of things are quite normal and expected for a good long-term bull market. If we were to have a short term bull market, then you expect it to just kind of keep rising with no 2% pullbacks all year, which is what it's done. And so that just I think that leaves you more likely to kind of have the bull market fizzle out faster and enter a new bear market sooner, which is a drop of 20% or more. Um, that's what I'm watching right now is the trend, the intermediate trend, the 50-day moving average is still moving higher. The long-term trend, which is the 200-day moving average, is still moving higher. The 10 and the 20 have kind of flattened out. So, if those start pulling down, then we're definitely in more of a short-term pullback. And so we're kind of in the middle right now. But again, I wouldn't be surprised to see another 10% downside for the S&P 500, and I don't think that's anything really to panic about.
Yeah. And I would agree fully with you. It's just part of normal market functioning that you would have a 10 to 15% pullback, or you could see it move sideways for a period of time and correct that way. But
you know what else is interesting, Kyle, is that Nvidia is currently in its second 20% correction or bear market of the year. So Nvidia, the darling stock is down, I think, 24% from its highs this morning. It's bounced off the lows, but this morning it was down about 25% from its highs. It dropped more than 20% once earlier this year in April. And so Nvidia is in its second bear market of the year.
Yeah.
If you want to look at it that way. And it's still insanely overvalued. So be careful with that one. But if you were looking for a spot to get into Nvidia, you might have just had your chance.
Yeah. And it's an important point you bring up is Nvidia has been this stock that people look at and they're like, well, why didn't I just own that with all my money? And you and I have talked about this before, but having too much capital allocated to that and having normal pullbacks of 20, 30%, you're not sleeping at night, and it's unlikely you would ever actually hold that position as long as you would need to.
Yep. Some people have, and kudos to them. I mean, I was actually just looking, I was on LinkedIn a minute ago, and somebody had posted some quote from Seth Klarman who said, the greatest thing that an investor should hold dear is the ability to sleep at night. That's like the most important thing for a long-term investor. So funny you mentioned that. I got the quote. I probably just butchered the quote, but I literally saw that 5 seconds before we jumped on the call. So I think it's funny that you mentioned that. So yeah, Nvidia is definitely in the midst of a pullback. If you were looking for an opportunity to get in, you can buy it here at maybe only 25 times sales instead of the normal 35 times sales. I think that's a terrible idea, and I think your long-term returns are likely to be poor if you do that. But if you're just doing it for a trade and for some momentum and some exposure to the biggest 10 stocks in the world, then have at it in the right size. Better to buy it on a dip than at a new high.
And so Nvidia, they have earnings at the end of August, but one of the Mag 7 that we have had report was Tesla, and that's when the story was changing, right? Where everything was in the clear, the robo-taxis coming, all this. And when I look at the chart, I mean, it just got butchered yesterday. And now, if I'm just looking at the technical picture, we're just still in a big downtrend. So I'm just curious, any thoughts on that? That's really been the first big earnings read through for that sector of the market. But
my goodness, I'm sorry, I was wrong. Nvidia still trades at 36 times sales and 67 times earnings. So that's not much of a dip. Sorry to interrupt, but I had to look. And yeah, it's funny. I'm glad you brought up Tesla. Tesla, as of earlier this year, and I don't know about right this second, I'll tell you. But let's see. As of right now, today, Tesla is still 47.5% below its 2021 highs. Yeah. So not doing good. That's what you call a downtrend. For Tesla, the 200-day moving average is pointing down, but the 50-day moving average is ticking higher because it's been on a short-term run from about 140 all the way up to about 275, and now it's pulled back to about 220. So Tesla earnings were awful. They reported their fourth consecutive miss. Their earnings and profitability were down from a year prior again. So they're selling fewer cars at lower prices which causes margin compression and then multiple compression or destruction, if you want to call it that as well. So, Tesla's biggest problem is that the more success they have in producing cars, the more likely the market is to value them as a car maker. And car makers generally get like, very, very thin margins. It's not a very good business to be in, right? It's not software. It's a whole lot of, it's very capital intensive. You got to buy all the parts, you got to build the car, you got to pay for labor, you got to have a factory, you got to ship the car, you got to sell the car, you got to pay commissions, you got to do all these things. And don't get me wrong, Tesla's found innovative ways to sell cars and build cars and all that kind of stuff, but it's not free. And their margins are way, way higher than most other car companies. Their multiples are obnoxiously higher than other car companies. Like it's not even comparable.
Yeah.
Uh, and they could have bought Ford. Ford was actually down 17%, I think, this morning. So like Tesla lost more in market cap on its earnings the other day than the entire market cap of Ford is, right? So Tesla was down more than Ford's market cap in just one day, and they could have just issued shares to all Ford, bought Ford with shares of Tesla stock, and then they would have had a real car company to run the car business, and Elon Musk could focus on AI and rockets and robo taxis and Twitters and all the other stuff that he's into. But he didn't do that, and I can't make it up. You probably haven't seen this yet because I think it just happened as we were jumping on this call as well. Lots going on today, and we only got about 5 minutes left, so we'll have to probably move on from this in a second. But there is a headline out there today that Elon Musk ran a poll, I guess, on Twitter. I don't know if he ran it or somebody else ran it, but there was a poll on Twitter, one way or the other, about Tesla investing $5 billion into Elon's new startup called XAI, which is an AI company, whatever the heck that means.
Yeah.
And so in the middle of the car company struggling to sell cars, right? They're selling fewer cars than they used to sell. They're doing it at a lower price than they used to be able to sell them because there's tons of competition in the EV space now. Pretty much everybody who wants an EV has an EV, so that's why the volumes are down, and they're having to drop prices to attract buyers, but it's not working, as evidenced by the volume being down. So I mean, they're selling fewer cars at lower prices, and for some reason, it's a good idea to take $5 billion and invest it in an AI company. When Elon Musk, the entire time that he's owned Tesla, has always said, like, oh, yeah, we're not a car company, we're a energy company, and we're going to have our own AI because of all this data we're collecting from our vehicles, and we're going to be an autonomous vehicle company that's got all this artificial intelligence. But now he's got a separate company, and he's going to take Tesla's capital and invest it in that company. And I'm sure the shareholders will approve it because that's like they probably all just voted on it, and they approved these obscene pay packages because people just are big fans of Elon Musk. And in a lot of ways, I'm a big fan of Elon Musk, just not as the CEO of a public company. I don't think he's very good at it. I like his politics, I guess, and I like his free speech, and I like where he's at with the woke mind virus and trying to eradicate that. I think all that's fantastic, but my goodness, and I would, where I'd hate to run into him is on a used car sales lot because he could probably sell me a car faster than anybody in the world. Guy's a heck of a salesman, but I think. I don't know. I think some of these ideas of taking Tesla's capital while the business is struggling and investing it into one of his own startups where he's going to benefit more than anybody else. I don't know. There's just something about it that feels not right, and we'll see how it goes in the long run. But I don't know, man. There's always a new headline of involving this guy and his companies, and it's just the story just keeps growing and growing and growing. So
Yeah.
really interesting.
Yeah, it's interesting. And, just on the car company idea, I was looking into just household debt and kind of checking in that. I know we've brought it up before, but now you've got auto loan delinquencies picking up, credit card delinquencies picking up, and you're selling now to a consumer that really just can't afford it anymore. So it's not looking great out there. It does look like a recession is looming. We'll see kind of what the outcome is here, but for now, I mean, the stocks, well, I shouldn't, I'll correct myself. The stock market as defined by the S&P 500 weighted with Nvidia still looks good.
Yeah.
But generally speaking, stocks, it's not the kind of market we'd like to see, but we just manage money for the market we're given, not the one that we hope for. So,
Yep. And we'll see what happens. I mean, you never know which 5% pullback is the beginning of the next 30 or 40% drop. You just never know which one. That's why I think it makes a lot of sense to follow volatility based trailing stops on your positions. I mean, sure, there's some things that you might want to hold on to forever, but for the vast majority of companies, you want to get out before they go down a lot. And then if you want to buy them back, buy them back. So we'll see if this turns into, like I said before, we dropped below the 50-day moving average this morning. We dropped below the trend line, and we're still below the trend line as of when we're talking right now. These market drop days of 2% or more um, tend to kind of congregate around each other. So we're overdue to have a few more of them, and you never know. It could be 3 or 4 or 5% drop days. It's not unheard of to see that happen at the peak of a bubble market. So, a couple further things I'll say before we wrap up here. But the consumer, like you said, is definitely getting crushed. I mean, I put some stuff in the commentary about Pepsi and McCormick and even JP Morgan. We had Lamb Weston out, which surprised potatoes to all the fast food companies, and they got smoked by 28% yesterday, which was a position of ours. Unfortunately, we stopped out of it. It was a small position, thankfully, but we got crushed on that one. So people aren't buying as many French fries. People aren't shopping at McDonald's as much. I shouldn't say shopping, but eating at McDonald's as much. They're not going to Starbucks as often. All those kinds of companies are getting killed. Nike had its worst day in history recently. We also stopped out of that one. So I mean, if you're not in the Big Ten, there are things that are, and I don't mean football or NCAA Big Ten, but the biggest 10 stocks in the world. If you're not in those, there's plenty of carnage out there, and this just in, like interest paid on U.S. consumer non-mortgage debt. So all the debt out there, the interest being paid on credit cards and everything that's not a mortgage spiked by 50% in 2023, the highest increase in 27 years. By comparison, the previous record was 14.1% in 2000, which was 1 year before the 2001 recession kicked in. So that is a bit of an ominous sign. And at the same time, interest paid on mortgage debt also jumped by 13.8% last year. So some of these numbers are finally rolling in. And I mean, I didn't need the numbers to tell me people were paying way too much in interest. Our government is paying way too much in interest. We're paying over $1 trillion a year just in interest now. And that's projected to do nothing but grow. And one last thing I'll say, and then you can add anything you want, Kyle, but we're slightly over time here. But $2.1 trillion of U.S. excess savings has been spent over the past 3 years. So all that money they printed during COVID and sent to people, and a lot of people put it in their checking accounts and all that. It's all been spent. So $2.1 trillion of excess savings were spent over the past 3 years. As a result, cumulative excess savings are now negative $170 billion. If you're not sure what excess savings are, you can just type that into the Google or the AI machine and you can learn a little bit about that. But we're now negative 170 billion from being positive 2.1 trillion. And at the same time as that, serious delinquencies of 90 days plus for credit card debt and auto loans have spiked to the highest levels in almost 15 years. So, I mean, we'll see what they can do. Maybe just keep printing money we don't have and stealing from the future generations of Americans to finance deficit spending. That can make the market go up for a lot longer than it ought to, which is exactly what's been happening. So it could happen for a bit longer, but none of that's really good in the long run.
Yeah. So we'll see. Certainly not a positive thing, but I'm curious to see our meeting, 1 month from now, what that looks like, because like I said, now we're sitting on support. So will the market, change its mind here? We'll see. But for now, it is still in that uptrend. So to be
The uptrend is
determined.
intact. It's precarious, but it's intact.
It is. So great. Well, I know we're just a little over time, so maybe we'll end it here. But Shane, thanks as always for hopping on, and we'll see everyone in a month.
Thanks, Kyle. Good talking with you, brother.
You too. Bye.
See ya.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.